Chapter 1, Market Basics. In 1908, a novice investor is to ask J.P. Morgan, the great financier who was then America's wealthiest man, "What will the market do, J.P.?" Without hesitation, J.P. came up with what I consider to be the most single useful investment principle. J.P. replied, "The market will fluctuate." I believe J.P. was alluding to two salient facts. First, without movement, be it up or down, no investor can make a dime. Volatility is the investor's friend. If markets didn't gyrate, we'd all be left with the equivalent of a portfolio of certificates of deposit. The value of a CD is, of course, fixed, and given current anemic yields, ownership is akin to stuffing your money under a mattress. In fact, given that inflation historically ranges from 2 to 6%, these days all CDs lose you money, guaranteed. Ergo, to protect your hard-earned dough, let alone increase it, you have no choice but to invest in securities, however mercurial. Second, no one, not even J.P. Morgan, his uncommon talent and years of experience notwithstanding, knows what the market will do. Not he, nor his inquiring novitiate, nor those of us facing the complexities of 21st century markets can base investment decisions on supposed predictions, however persuasive. For the sad fact is, neither Harvard economists nor Wall Street experts have yet to conjure up even a soupçon of clairvoyance with which to identify those stocks that are going to advance versus those heading for a fall. Contrary to the vociferous affirmations of, and bookshelves of obtuse scholarly tomes written by, technicians and chartists, there are no consistent formula for predicting market behavior. Every celebrated system designed to second-guess the market does indeed appear to work until, inevitably, it doesn't. But the failure goes beyond an eminently reasonable inability to predict the future. What I find striking is how consistently Wall Street professionals get it so extravagantly wrong. The best all those diligent, computer-savvy technicians and chartists can offer us are some useful data as to what the market is doing now, not what it's going to do. Let me say it again. Claims that a particular pattern of past movement foretells future behavior of a particular stock or group of stocks are no more supportable than the roulette wheel gambler's assurances that because the wheel has come to rest on black a half dozen times in a row, there's a many-fold likelihood that the next spin will come up red. No such luck. Past performance is not predictive. Not in Las Vegas, not on Wall Street. Likewise, there's little relationship between the earnings estimate offered by securities analysts and how the companies they cover actually perform. The reason is obvious. Analysts are paid to be optimists. Note that less than 10% ever issue sale recommendations, and those few who do risk losing their jobs. But however useless a prognosticator, technical analysis can provide serviceable contemporaneous information, a window on what is happening today. For example, it can tell you whether at this moment you are investing in the midst of a bull market, a bear market, or one which is volatile, cycling up and down, or nearly flat. It can ascertain whether a particular stock is expensive or cheap against its own historical performance. It can determine a company's return on capital, by which I mean how much by way of profits a company is able to generate relative to its overall net worth, and price-earnings ratio, by which I mean how much you pay that day for a share of those earnings. In turn, a measure of Wall Street's expectations for that company. Obviously, you want return on capital to be high, reflecting efficiency in the company's use of its productive capacity, and the price-earnings ratio to be low, suggesting a possible investment bargain vis-a-vis the company's future ability to generate profits. Financial rewards, conventional wisdom maintains, are commensurate with risk. The market is not inclined to reward you with great sums for playing it safe. Remember my comments about the CD. Squirrel away your money in a savings account, And though entirely secure, not only is your money not up and about working hard for you, it's sound asleep. If you're lucky and inflation rates remain uncommonly low, you might break even. By contrast, should you choose to speculate on, say, cotton commodity contracts, a single trade could reward you with a return of 1,000% on your investment. That's right, 1,000%, if you're lucky. Unfortunately, most commodity traders quickly manage to lose their cotton or wool or silk shirts. Similarly, while day traders can theoretically make a lot of money in a hurry, all the traders I know seem to lose a lot of money in a hurry, giving rise to a simple formula. Start with one's entire kitty as a numerator, divided by the number of trades made over the course of the year, and that will equal the amount of money left by December 31st. To paraphrase, the quickest way to a small fortune is to start with a large fortune and become a trader. As you've doubtless discerned, the ambush investor makes few trades and is in for the long term. This brings us to the first rule of ambush investing, and one which informs every chapter that follows. Rule number 1, minimize risk. You might well be an uncommonly astute stock picker, and perhaps even one of those rarer birds, a prescient market timer, thereby ensuring terrific returns. But if at the same time you're risking everything by ignoring the safeguards I'm going to outline here, it doesn't matter how much money you briefly make. Our principal concern that you not lose money subordinates everything else. Consequently, we will shortly discuss not only how to make inspired choices most likely to generate substantial rewards, but describe ways to simultaneously so reduce risk that you get to retain most of your gains. One reads that, quote, all the great entrepreneurs of history have made great fortunes, lost them, then made them again, unquote. Good for them. Such a scenario might work swimmingly for Donald Trump and his ilk. But with all respect for the world's super risk, the ambush investor pursues a decidedly less exciting road to wealth, and one far more